guys, good afternoon and welcome to Money Control. I'm Karunya Rao. In conversation with me today is Nitin Sharma of Money Control Pro, and all eyes today will be on oil prices and, of course, some developments on the domestic news front as well, which could impact fuel prices. Hi, Nitin. Thank you for talking to us today. First up, I want to address the big news development. Windfall tax on crude oil has risen from 13,000 per ton to 13,300 per ton. At the same time, we're also looking at an export duty hike on ATF, which is used for aircrafts as well as diesel. What does this mean for you and I and for everybody else? Could there be a rise in the fuel prices as well, the money that we pay at the end at fuel stations?
Thanks, Karunya. So yes, this revision is interesting. First of all, as we know that crude oil prices are not at a June-July levels now. However, diesel and ATF's hike in export duty is higher than the July itself. When it was on ATF, it was 6 rupees per liter, and diesel it was 13. Now it's 9 rupee per liter on ATF and 13.5 rupees on diesel. Now, what has happened is that in July, India's crude import jumped around 6.5%. And while it is 5% lower than the April levels, but in terms of value, it's marginally lower because of the weakness in the currency. Similarly, refining margins also improved in August. As we remember, the refining margins across for all the automobile fuels as well as the crude oil were touched a peak in July and early August, and then plummeted from there onwards. But in last 2 weeks, it jumped all across. Reason being that the European nations, as they are preparing for the upcoming winter season, they're trying to look for all the available fuel that they can use. And as we know that Nord Stream 1 pipeline supply has been shut as of now, so their diesel consumption has gone up. One example is that even American diesel export to Europe has increased historically. So broadly, this is what's happening behind the scene. Problem with ATF is that the currently ATF is being sold at around rupees 120 to 128 rupees per liter, and in Europe the ATF spread has jumped. So previously it peaked at $69 per barrel, and then it went all the way down to $34 per barrel. But since then, it has jumped around 50% to around $50 per barrel. And then last couple of days, it has seen some correction, but still remained at quite high, around $40 per barrel. So what happens is that when you look at the India's export data with regards to ATF, it has not come down as significantly as diesel is, and because of which there is a fear that the export for ATF might increase by the refining companies. Secondly, the airline sector, as we know, facing some challenges, despite that, just to name one, and likely government doesn't want any sort of ATF volume being flown overseas. So that is what's going with the ATF. With regards to diesel, so in July, the month-on-month diesel consumption domestically fell by 14%, while the spread for diesel in European market is around 27 to $30 per barrel. So it works out to be around rupees 15 per liter. So that creates an opportunity for the refining companies to sell it overseas. So when you look at it, the level has been increased to just try to pare it down, basically to curb the motivation for the export.
Nitin, tell me one thing. Prima facie, do you think this development and also the volatility in crude oil prices could have a bearing impact on the listed companies back home, whether they are OMCs, the likes of BPCL, HPCL, or even refining companies?
Okay, so on refining companies, the problem is that refining companies are facing pressure in terms of refining margin. As you remember, in first Q, uh, refining margins were at multi-year peak, but this is not the case anymore. So that is one challenge. Secondly, since then there is a windfall tax, so that is the another problem. And thirdly, retail prices are stuck where they were, so they continues to make losses on every liter they sell. So refining as well as the OMC companies are not in good position, and I will not be surprised if their losses widen in Q2 as well. Now, when we talk about the E&P companies, so domestic E&P companies, I don't think they can make any supernormal profit here onwards, because uh, given what kind of windfall tax government is charging, and every 15 days being revised, so effectively locking the realization to around 70 to 70 dollar per barrel. So even if in the international market crude is near $100, but it doesn't seem that there's any upside for E&P companies in terms of realization.
And what about aviation companies? Obviously, they've been under severe pressure last 2 years because of COVID-related disruptions, and now when things have started looking up in terms of demand, fuel prices definitely has been a big pain point, especially given that a huge part of their cost is just ATF fuel.
Yeah, right. So rightly said. Typically, around half of their operational cost goes into the fuel and those charges. So, given that prices continues to remain high, is one problem. Secondly, because there was a price cap on the ticketing, so they were facing some challenges. But now that there's a consolidation pending for Tata Group, for all three of the airlines that they operate, and then Mr. Jhunjhunwala's Akasha Airline is also in the market. So it is expected that competition will increase in terms of pricing, and airlines sector as it is, price competition is not good for all the players. So it should be interesting, good for consumer. Prices might come down.
Okay, all right. But overall, for oil prices, what do you think is likely to happen as a larger trend for the coming months? Because of late, it has been very volatile. We've seen, seen it largely trade under $100 a barrel. Talk to us about the way forward and what is the forecast that you guys are predicting?
Right. So overall, at the end of this year, previously market was seeing close to a million barrel per day kind of a surplus by end of 2022. But yesterday's OPEC report suggests that they see a very small oil surplus by end of this year. Uh, and then there are other set of problems. So there are too many unknowns at this stage. One is that lot of discussion is happening with regards to Iran deal, but the deal will have to go through a lot of hurdles before it comes into effect, both in terms of negotiation as well as the US domestic politics. Then we don't know how much production they are will do going forward from here. They do have a certain storage in terms of floating storage, which might immediately come to market, but we don't know exactly what kind of overall oil that can come to market. Secondly, Russia-Ukraine war. So it is entering into a new phase. The Ukraine army's second southbound movement to dislodge Russia is going to complicate matters. Thirdly, US SPR is now at multi-year record low. So before the next summer season, so before March, they should start refilling their storage, and that should also increase the demand for oil in the market. Finally, as we saw in the news that one of the largest industrial city in China, Chengdu, is under lockdown. So that might create some demand side issues from China. It's a major concern. So overall, there are too many variables at the play. However, I don't think we would see Brent below $90 per barrel at least this year. It might even trade around $100 barrel.
Okay, well, Nitin, thank you so much for joining in and for letting us know about the key developments, key triggers that are moving crude oil prices and the best and worst case scenario that could pan out as far as oil is concerned. Thank you for joining in. And guys, thank
Thank
you
you.
for tuning in. We'll be back again tomorrow at 1 o'clock with a fresh update on commodities.